Sunway Berhad was founded by Tan Sri Dr. Jeffrey Chia Fong Ling in 1974. The company is a Malaysian conglomerate where they are involved in property development, construction, real estate investment trusts, leisure and hospitality, healthcare, trading and manufacturing, quarry, building material and education. Some of the countries they sell to are Malaysia, which represents about 85.3% of their total revenue for financial year end 2020, 3.4% comes from Singapore, followed by China 7.1%, and the remaining 4.2% comes from India, Australia, Indonesia, United Kingdom, and other countries. For more information, you can visit their website at www.sunway.com.my. A bumpy but growing revenue and gross profit. The only time where their revenue and gross profit were heavily affected is obviously during the COVID-19 season. A large increase in operating profit in financial year end 2013, boosted by a one-time gain from fair property valuation gains and accounting policy adjustments. Nevertheless, operating profit dropped 89% after that due to the higher operating expenses and finance costs. Gross profit margin was growing slow and steady. On the other hand, the operating profit margin and net profit margin have been dropping slightly over the years. Operating profit margin and net margins was higher than their gross margin in financial year end 2013 thanks to the one-off gain from fair valuation and accounting adjustment. Also, notice Sunway's net profit margin has been above their operating profit margin in most years, as this is attributed to their additional share profit from its associate and jointly controlled entities. A sharp drop in ROIC after the large increase in financial year end 2013 as a result of higher costs explained in the previous slide. Quite stable profit after tax overall. Plus, management has been conservative with their remuneration, sitting at 4% remuneration to PAT ratio on average. Sunway has been a net debt company for 10 years. However, what's concerning to me is that 70% of the total debts are short-term in nature. High capex incurred during the stated financial years, it is due to the increase in property acquisition and many more. Sunway paid dividends for 9 years, which is great, though the payout starts declining since financial year end 2015. Negative free cash flow incurred in those stated financial years due to the high capex spending mentioned in the previous slide. Thanks to their high cash reserve, they are able to pay out dividends in financial year end 2014 to 20. All in all, I rate their company 4.3 out of 8, which is about 53.75%. Not a financially strong company in my humble opinion. Anyways, here are my further comments about Sunway. Number 1, as a company that owns multiple business in different industry, it is no surprise that their financials are not as attractive as other fast-growing companies that specialize in one business. In my opinion, it is very slow growing, but at least it's performing much better than other conglomerate companies in Malaysia. Though two things that concern me the most is their fall in profit margins, ROIC, as well as their large leverage on short-term debt. I can understand that their business are heavily involved in properties, which makes sense for the slight drop in profit margins and ROIC with the inevitable rise in operating and finance costs. However, their short-term debt is what caught my attention. It doesn't make sense to me that a property/construction company would want to take on more short-term debt as opposed to long-term, since it usually takes more than 1 year to build properties. I don't know, maybe you guys can enlighten me on this. That's all for today's video. Hope you guys enjoyed the analysis. If you did, make sure you smash the like and subscribe button. If you have any questions, feel free to comment down below. I'll be happy to get back to you. With that, I'll see you on the next one.